Welcome traders, Maciej here from Taurus Trading. Do you want to take the most important step on the way to your financial freedom? Well, let me show you how very simple approach to the markets can help you to become successful trader. I guarantee that by the end of this short video, you will be surprised how such basic strategies are used by the most profitable hedge funds. If you want to follow traders with proven track record and start making real money in financial markets, all you have to do is simply copy the best guys in this business. So let's get started. First, let's start with what are future markets. A futures contract is a standardized agreement between two parties either to buy or sell an asset for a predefined price at a certain time in the future. The current price is simply the price for one futures contract today, with delivery of their underlying asset at the predefined delivery period. Future contracts are similar to forward contracts in many ways, but futures are normally traded on an exchange rather than over the counter. The exchange also provides the two parties a mechanism that gives them the guarantee that contract they have entered into will be honored, as the two parties most likely do not know each other. When constructing a contract between the two parties, the agreement between them must be specified in exact detail. The underlying asset to be delivered, the size of the contract, where and when the delivery will occur. There is also room for alternatives to be specified. For some commodities, the grade of asset is also important to specify in the contract. The quality of the commodity may vary according to where it is produced and therefore needs to be specified. The value of a futures contract for a simple asset with no dividends is equivalent of the value of investing the present value of the underlying asset in a risk-free investment until the futures contract's time to maturity. The valuation formula can become more complex if the underlying asset is in short supply or does not exist. On exchanges throughout the world, there are contracts on a vast amount of different commodities and financial assets as the underlying asset in the futures contract. One important thing to take note of is the fact that the vast majority of the future contracts do not lead to a delivery of the underlying asset. This is because most traders use these contracts not for the delivery of the asset, but as a hedging instrument or for speculation about price movements. To close out a position in a contract prior to the delivery period, the trader enters in the opposite and equal trade to the original one taken, thereby offsetting the original position in the contract. Delivery is so unusual that when it happens, traders have been known to sometimes forget how this delivery process works. For some futures contracts, with financial assets as the underlying asset for the contract, delivery is simply impossible and they are thereby settled in cash between the parties. A futures contract on the S&P 500, which is an index of biggest 500 United States companies, would otherwise result in the party with the short position would have to deliver a vast portfolio perfectly replicating S&P 500. The futures markets are heavily regulated in the USA, for instance, by the Commodity Trading Commission. They license futures exchanges and contracts and approves changes to these contracts. This means that the contracts must serve some useful economic purpose in order to be approved, in example, not only for pure speculation by traders, but also as an instrument for hedging. By the way, by hedging, I mean that if you are a farmer, for example, and you're growing corn and you want to secure the price which is valuable for you to sell the corn, you probably want to do it by selling a future contract of corn in the price, which for you means you're not losing any money. Two parties can, of course, agree to trade an asset by themselves in the future for a specified price settled in advance, but this is highly risky due to the counterparty credit risk, partners not having the financial capacity to honor their agreement. As mentioned previously, the exchanger is responsible for organizing trading and to prevent contract default due to the lack of financial resources from one of the parties. They do so by using a margin account for the parties in the contract. When an investor wishes to enter into position in a contract, a margin account is open for this position. The investor needs to deposit an initial amount per contract to this account. This is known as the initial margin. The amount per contract varies greatly depending on the underlying asset and market and is usually about 10% of the initial value of the contract, but it varies depending on the volatility of the underlying asset, but is usually between 5 and 15%. So for example, if today's price of S&P 500, which as I've mentioned already is an index for 500 biggest US companies, where if the price of this instrument is $3,000, that means that initial margin, if we're talking about 10%, will be $300. That's how much you have to deposit on your margin account. As it is just a fraction of the underlying amount, an investor can trade on the margin and achieve a higher leverage. This is of course risky if not properly diversified. Then, at the end of each trading day, this account is adjusted after gains and losses. If the account drops below the initial margin amount, the investor needs to refill the account to a required level, otherwise the investor will be forced to unwind the position. The investor is allowed to withdraw an amount from the margin account as long as the account exceeds the initial margin. The contract size is the amount of the underlying asset that is to be delivered by the investor holding the short position in one contract. If the size represents too large an amount of the underlying asset, investors wanting to hedge a small portfolio will be unable to do so, and speculators might be forced to take a larger exposure than desired, or may be unable to enter into the desired position. If the contract size is very small, that will lead to higher prices due to high costs for multiple trades. An example of a contract size is the size for a future contract on corn that represents 5,000 bushels of corn. Point value is the lowest amount with which the price can change. The code for the contract is defined by the exchanger and consists of three parts. The tick for the underlying asset varies depending on the data vendor, which may be confusing when using multiple data vendors. An example for tick of a futures contract is GC. This is a future on COMEX gold. The month for which delivery of the asset is to occur is denoted by the following schematic. From January to December is F, G, H, J, K, M, N, Q, U, V, XZ. The year is then denoted by the last digit of the year. When the futures contract is approaching the delivery period, the price of the futures contract will begin to converge towards the current spot price of the underlying asset, and finally will be equal to or very close to it when the delivery period is reached. Why this is easily illustrated with that otherwise there would be an arbitrage opportunity. If the future price is higher than the spot price at the delivery period, an investor would simply short the futures contract and buy the asset and deliver it. This leads to certain and risk-free profit for the investor, a profit equaling the amount by which the futures price exceeded the spot price, and vice versa for when the futures price is below the spot price. This leads to the fact that the future price will converge towards the spot price when the contract approaches the delivery period. When the futures price is higher than the expected spot price at the delivery for the underlying asset, it is said to be in contango, and the contract will decrease in value until the delivery period, where it will be, as mentioned previously, equal to or a little more than the spot price at delivery. The reverse situation is known as a contract being in backwardation. In example, the value of the contract is lower than the expected spot price at delivery, in which case the value of the contract will increase until it reaches the delivery period. Managed futures traders are commonly referred to as a Commodity Trading Advisories (CTA) and are a special kind of hedge fund that has its origin in the trading of commodities future contracts. The acronym has its origin in the 1970s when the Commodity Future Trading Commission was founded in the USA. The general term commodity was at the time broadly understood to cover all forms of futures contracts. A CTA can be described as an organization that provides futures contracts, commodity options, and swaps for a client. They generally act as asset managers using different strategies for trading with futures contracts or options on futures, and are currently the largest subsection of what is known as alternative investments, traditional investments being equities, bonds, money market, and real estate. There are many types of managed futures strategies that CTAs use, but the most common one to use is a systematic trend following strategy, where different methods are used to identify a trend and momentum in the market, regardless of its direction, and profit from set price trend in the market. Two other common strategies applied by CTAs are fundamental trading and short-term trading. Trend-following CTAs have done well in both bull and bear markets, but particularly in periods of market distress due to the negative correlation to the equity market. CTAs are also highly restricted and sensitive when it comes to what they actually do and how they do it, not wanting to release any unnecessary information to outsiders. These CTAs primarily take positions and trade in futures markets using futures contracts and sometimes options on futures. The portfolio will usually be exposed to numerous markets and asset classes like bonds, stocks, energies, agriculture, metals, forex, or cryptocurrencies. One of the main reasons for using futures in the portfolio is the belief that it will decrease overall risk due to a history of negative correlation between asset groups. This negative correlation is also the reason why managed futures are used by, for instance, pension funds as a tool to diversify their portfolio and reduce risk of the portfolio and capitalize on its historical track record of CTAs during times of distress for traditional investments, as seen during the 2008 credit crisis. By investing in CTA, they will have an exposure to assets that move in different ways from the traditional investments like stocks and bonds. Since CDAs are just slightly negatively correlated to the S&P 500, they are therefore not a perfect hedging instrument for the stock market, but an investment in CTA can be considered as a diversifier for stock market risk and should therefore make up a minor part of a typical financial portfolio. Most of a CTA's assets under management will be in the form of cash. A smaller but highly volatile part will be in the form of unrealized profit on active positions in futures contract. The cash held can be used to buy new futures contract or resize already active positions in futures contracts. It is also possible to trade on the margin and achieve a higher leverage. Trend-following investors seek to capitalize on prices systematically rising or falling over days, months, or even years. For trend-following strategies that use a diversified portfolio of futures contract, it is common that up to 70% of all trades will be losses. That might seem like a high number, but the illustrious track record of trend-following CDAs is not due to the number of successful trades they make, but the size of the very successful ones. Due to the nature of the strategy, a typical trend-following investor has a large number of small losses and a small number of huge profits. The main aim for a trend following strategy is to follow an already occurring trend in the price time series and follow it as long as the price does not make a significant move against the trend. This means that the strategy of trend following is deliberately targeting not the lowest point, but rather more the middle of an already occurring trend and trying to capitalize on the trend to continue for a long period of time. For the most part, such a strategy will enter into a lot of potential trends that will not continue. The investor will close these positions rather quickly and make a loss. A single futures symbol can remain for a long time without a long-lasting trend to follow, and it results in many, but in comparison small losses. The financial instrument may in fact never enter into a long-lasting trend, but for a trend follower with a well-diversified portfolio, this is not a problem because long-lasting trends will likely occur in other instruments, and the profits made on these other instruments will more than make up for the poor results during non-trending periods when considering historical data and performance of CTAs. The essence of following a trend on futures contracts and the underlying economic justification for it is based on time series analysis and behavioral finance. Time series analysis can be used to predict or determine whether the time series of the financial instrument is trending, and theories from behavioral finance can be used to explain why and justify the phenomenon from an economic standpoint. Trend following is a widely used strategy in futures markets and has been so for decades. If one just looks at the vast amount of successful CDAs using trend following strategies on managed futures, one will see that they have been active since the 1970s using trend following strategies. The core concept of trend following is systematic movements in the price time series of a financial instrument. The core concept is not to identify and buy at the price series very lowest value and sell at its highest. It is to capitalize on long-term price movements. All trend following strategies are based on this conception that financial markets tend to move in trends for an extended period of time. They can trend up or down, or the financial markets could move sideways, which is the phase where trend following strategies make the most of their losses. It may be the case that a financial price series most of the time is not moving in a general direction for a long period of time, but the assumption is that there will always be periods where it is moving in a general direction for a long enough time to capitalize on it. Trend following strategies tend to make almost all of their money during limited time periods and from a small number of very successful trades. Trend following strategies are different in distribution to simple buy and hold equity strategies. The returns of trend following managed futures strategies are typically non-correlated or slightly negatively correlated with the equity market and are positive in expectation with a large amount of small losses, and are also positively skewed with a fat right tail, as managers tend to allow winning trades to run and quickly cut losses as momentum or general trend movements in the markets fade. For a trend follower, it is all about waiting for the market to make a significant movement and hold the position if that trend continues. Trading signals are used in the order to determine when to enter a position, and they can be generated by various methods. The two most popular and highlighted in the literature about trend following are two classical but still widely used methods called breakout and moving average. A long position is taken if the method of choice is giving a signal for an upward trend, and a short position for a signal of a downward trend in the price series. The purpose for all methods used for identifying a trend is to see past the underlying noise that exists in a time series. The method described here is a classical and rather simple, but an effective one, and it is called the N-period channel breakout, or just breakout. The N refers to the number of points in the time series that make up the look-back period. The price series for financial instruments are usually made up by trading days, and N would refer to the number of previous trading days, including the current trading day, and the data points under consideration in the time series are the closing prices for instrument. This method can be used for both determining a positive trend as well as a negative trend in the price series. If the closing price for the present trading day is the highest closing price the last N trading days, including the present day, a positive trend is signaled for and a long position should be taken. And conversely, if the closing price is N day lowest, a negative trend is signaled for and a short position in the financial instrument should be taken. Moving average is one of the most widely used operators for statistical analysis of a time series, and it is a series created from the average for a rolling subset of length N on the full time series. It filters out high-frequency fluctuations in the time series while passing through low-frequency components of the time series. In example, it filters out short-term fluctuations and keeps the long-term movement of the time series. In other words, it illustrated the underlying trend in the time series. This smoothing effect of the time series is due to taking the average of a subset of the time series, a look-back period of the last N data points, which reduces the fluctuation that has occurred during the look-back period. A 10-day moving average will, for instance, reduce the less than 10-day fluctuation in the data series and completely eliminate the 10-day fluctuation. But it is important to note that the smoothing of the time series will lead to an inherent delay in the smoothed time series moving averages series. This is referred to as lag, and it means that changes in the full data series will not show up and fully impact the moving average until some data points later. In example, it reacts slowly to a new trend. This delay is increased when using a longer time span for the look-back period. Another classic trend following method that is still popular among investors is based on simple moving average. A long-term SMA is used here as an indicator of trend direction. This look-back period can range from a few months to over a year, depending on the preferences of the investor, but the most common choice for trend followers is to use a 200 trading day look-back period for the simple moving average. When the instrument's closing price moves above the simple moving average, an upward trend is signaled and the investor should cover his short position in the instrument and immediately take a long position. When the closing price moves under the simple moving average, the method signals for a change in direction of the trend towards a downward trend, and the investor should sell the instrument and take a short position instead. So by using this method, the trader will always be in the market, as opposed to those using breakout as their trend following indicator. The intuition behind using this trend following method as an indicator is that the long-term simple moving average does not take any particular data point into consideration, but rather shows the general direction the time series is moving. It is certain that the most recent data points are relevant. It is less relevant what data points these should be compared with in order to determine the direction of the trend. The simple moving average will reduce the high frequency fluctuations and smoothen the time series so that a general trend direction can be seen. The appropriate choice of the look-back period for the simple moving average on the particular time series is harder to determine. The subject of using moving average as a trend filter is beyond the scope of this video. However, I will leave a link in the description to my other video in my channel about this very subject. So I hope this video was an eye-opener for you, and that information that I have provided will help you in your trading career. If you don't want to miss my new videos, which are already in the works, make sure to subscribe to this educational channel. By the way, I have recently put together a lot of valuable content regarding financial markets, so feel free to grab a copy of my ebook. Link to the website is in the description. I will talk to you soon.